We are now looking at the Dow down by about 535 points. Kevin, we've been doing this, the same rinse repeat cycle for weeks now during the war, watching the price of oil and then moving in the opposite direction for equities. Yes. We thought maybe yesterday we were through some of that, but that does not look to be the case this morning.
Yeah, certainly. The same market refrain continues, Becky, as when the prospects for a resolution in Iran go up, oil prices go down and stock prices go up. On the other hand, when the prospects for a resolution in Iran go down or get extended, as we saw last night, oil prices shoot back up, yields go up, and stock prices go down. So I think these short-term bouts of volatility are going to continue for the foreseeable future. But let's just say, for argument's sake, the resolution does materialize within 2 to 3 weeks. Then at that point in time, investors will start to shift back to all the underlying themes that were resonating in the market. And I think those themes can be found if you just follow where all the money was spent last year, is being spent this year, and will likely be spent for the balance of this decade.
You know, Kevin, the concern with that, though, is AI. The AI trade was not doing all that well ahead of this. We knew that the money was going to be spent, but all of a sudden Wall Street was looking at it a little differently, concerned about the cost, the capex of all of that, what that would mean, whether there was profit on the other side of that. What's your take on where we should be thinking about AI at this point?
And it's a legitimate concern, Becky, but I think focus less on who's spending the money and focus more on where the money is being spent. I've contended for a long time right now, if I could just use a baseball analogy in terms of what inning we're in the AI revolution, we're still in batting practice, and there's a double header of games ahead. Batting practice involves all the AI infrastructure spend, and the games, when they ultimately take place, will involve the transformation of the economy and society using all these intensive AI algorithms. But we're not going to receive return on investment for years to come. So focus on where the money's being spent right now, and that's on AI infrastructure.
I hear you, and we've heard similar things. We had the CEO from Valley Bank who, makes loans to all of these subcontractors and contractors who are building out the AI infrastructure. His loan book was up 30 to 40%. So I hear you, follow the money. But if sentiment on Wall Street changes more permanently and the idea of capex is frowned upon by investors, you are not going to continue to see the big hyperscalers spend quite as much money. At least I wouldn't anticipate you would, unless Wall Street tends to look on it a little more kindly. Or am I wrong on that assumption?
Yeah, I don't think the hyperscalers scale back that much in terms of their spending plans, at least not for 2026. And I think a company like Eaton Corporation, for example, the big industrials conglomerate that actually just recently purchased Boyd Thermal to buy their cooling solutions to tie into their data center construction business. Even if the AI revolution goes away, Eaton Corporation still stays in business, but they're benefiting from the AI revolution. A lot of people are concerned with Micron Technologies right now. As far as I'm concerned, the AI revolution comes to a screeching halt without power and without memory. When I think of memory, I think of Micron. When I think of power, I look to the utility companies. And utility companies provide a good ballast during these periods of volatility. They typically pay good dividends, and they've also become a backdoor play into the AI revolution. So I think that's a smoother way to play the AI revolution going forward, Becky.
Kevin, where do you look at the higher oil prices and what that might mean, either from an inflationary perspective or what it might mean from a growth perspective, if it slows down the consumer, if it slows down other businesses related to the consumer?
Yeah, I look at the most recent GDP Now forecast for Q1. It was just lowered to 1.9%. A large part of that is due, obviously, to high oil prices, which limits the ability of the consumers to spend. Remember, of course, 70% of our economic growth comes from consumer spending. So the longer oil prices stay higher, the less consumers will have to spend, and the more the economy will slow, which puts the Fed in a very tricky place, right? Because oil prices have inflationary pressures, which would mean they may want to actually raise interest rates. They shouldn't, but they may. And the economy may slow as a result of that, which means they may want to be more accommodative. So I think in all likelihood, the Fed stays where they are. Of course, we'll see if things change when Kevin Warsh becomes the new chair. But for the foreseeable future, I don't think the Fed doesn't do anything. And we're going to have to wait for a resolution in the conflict to actually see some respite with respect to oil prices and inflation.